Hello, Dr. Bernasa and friends. Today I'm going to talk about the nervous of mortgage post-COVID pandemic. The mortgage market came from a slow recovery from the 2008 economic crisis. Investor confidence was slowly returning due to the figuration and their relationship with lenders. In recent weeks, the pandemic has highlighted the problem arising from the change in the balance of mortgage, loan, and service from balance large banking institutions and not bank entities. Since the financial crisis, non-bank services account for nearly 50% of the market, compared to the around 13% in 2008, according to the data from the Housing Finance Policy Center. As the pandemic progresses, borrowers who feel the impact either because they were fired, suspended, or reduced their salaries ask their lenders to negotiate a possible pause in their payments. The problem with these requests is that the banks must comply with the capital payment and interest that they have to pay to the investors. But many of lenders do not have the sufficient cushion, generating a liquidity crisis. Although the government has intervened and reduced the pardon for 4 months, there is concern in the market about what may happen in the long term. There is a lot of uncertainty about what may happen in the third quarter of the year. The government has reduced employment benefits, which could cause more people to start the default or the mortgage. However, it has a positive structure. The recovery of market begins to generate confidence in investors and the economic situation of the country. This support in the reduction of interest rates of the Federal Reserve in uncertain what may happen in the long term and knowing the true effects of COVID. Employment continues to rise the figures never before seen, plus investors are aggressively regressing their exposure to credit risk.
Hi, I'm going to talk about Vienna MTF talking complexity out of the leasing process. How Vienna Stock Exchange catered to needs of a range of market participants, particularly in structured finance. For to explain the subject a little, Vienna MTF is a listing of bonds and structured notes. The Vienna Stock Exchange have a rich history, but in the midst of some market participants, it was only regarded as niche player in leasing-based security. According to Matthias Sau, director of debt listing, the public perception of Vienna Stock Exchange in the capital market changing. He said today two-thirds of new leasing come from non-Austrian issuers across Europe. This is because of offering a simple leasing process accompanied by an open-minded and responsive group of experts keen to engage in a dialogue to discuss leasing solutions. Vienna MTF offer a flexible and reliable alternative listing solution when debt insurers do not require regulated market but still require a listing or a recognized stock exchange. Their mission is to remove common barriers, so review producers on leasing documentation and excessive requirements. Um, what are the benefits? Debt insurers leasing bonds in Vienna MTF may choose whether to make information publicly available. Together with the investor, ensures know best what information is required and without reporting frequency in the most useful. Equally important, their part shape come to really on their for these responsibilities throughout the whole leasing process. Communication at most feels like begin a live chat with their leasing experts instead a formal and bureaucratic produce of making a submission to a traditional authority. For both Irish and English insureds, the withholding tax exception applies when leasing bonds on Vienna MTF, but virtue of the Finance Act 2008, the UK Eurobond exception also applies to securities admit to trading a multilateral trading facility operate but recognized stock exchange regulated in the European Economic Area. Vienna Stock Exchange is recognized stock exchange by the UK HMRC. Likewise, the Irish revenue has confirmed the Vienna Stock Exchange, including all of these markets, is recognized stock exchange for the purpose of Section 64 Taxes Consolidation Act 1997.